What about gold and silver? Well, all I have to say about gold and silver is that you need to hold on to your gold and silver for dear life because the markets are very volatile, and it's not people selling their physical.
And due to the fact the gold and silver prices in the first quarter of 2026 are higher still. So what does that mean? It means that probably we will see after we've had the decline, and we're going to have a decline. There's no messing up. It probably means that the prices will start to come back as these higher profits are announced.
As global markets face increasing volatility, physical gold and silver are emerging as crucial safeguards for investors. Recent fluctuations in stock prices and leveraged positions have temporarily dragged down precious metals, but underlying inflationary pressures and economic uncertainty suggest that these assets could rebound strongly. Rising bond yields, geopolitical tensions, and growing government debt are fueling concerns that traditional financial instruments may not preserve wealth, making tangible metals an essential hedge in turbulent times. A financial commentator and market analyst Mario Innecco emphasizes that rising global debt and increasing financial instability make physical gold and silver essential for protecting savings. He argues that investors should focus on holding tangible metals rather than relying on financial institutions, as banking systems and markets can become vulnerable during periods of economic stress. According to him, the safest approach is storing precious metals in private vaults or personal safes, ensuring direct ownership and control rather than depending on banks or paper claims. Mario Innecco also explains that recent declines in gold and silver prices are largely driven by speculators selling futures contracts to cover losses in other markets, not by people dumping physical metal. He notes that volatile stock markets, rising bond yields, and the growing difficulty for the United States to finance its massive debt could accelerate global de-dollarization and increase financial pressure on taxpayers through inflation, higher mortgage rates, and heavier debt burdens. In this environment, he believes individuals must stay informed, avoid misleading narratives about temporary economic pain, and maintain their holdings in physical gold and silver as a long-term safeguard. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying close attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
To inflate things, the debt is going to continue to grow. And there's only one way to protect your savings, and that's through gold and silver, physical gold and silver. How you hold it, it's up to you. Yeah, you need to find the best way, but I wouldn't hold it with a bank. I would hold it at a private institution, private vault, or I would also put some in Dirty Man Safe, right? One of our affiliates. And if you want to find out more about Dirty Man Safe, there's a link below in the description. And of course, I'm still trying to protect my savings via acquiring physical gold and silver, and I'm not going to stop. What about gold and silver? Well, all I have to say about gold and silver is that you need to hold on to your gold and silver for dear life because the markets are very volatile, and it's not people selling their physical gold and silver. Here's speculators selling the futures, right, to pay margin on their other holdings, which are getting hammered today, like the Dow futures, for example. Right now is down 700 points, but it's been down as much as 1,200 points. So it's all over the shop. It has rebounded since oil has come back down. The NASDAQ 100 future is down 1.5% as well, or 360 points. But it was down as much as 700 roughly, and the S&P as well, same thing. It's at down 88, and it's been down as much as let's see, 150 points, more than double what it's down now. What about gold and silver? Yes, they were sold off, gold and silver futures. Spot gold got down to 5,013. We're now around 5,100. down about 1.4%. So gold is down as much as the stock market. Silver is down actually just 1% at 83.60. So silver is doing relatively well. So the gold silver ratio is actually dropping slightly. And the more important market, which very few people will look at, of course, because it's where the smart money is, right, is the government bond market. Well, the Treasury yield curve continues to go up. Yields continue to go up, which is a bad thing. Don't forget, the United States has 9 trillion, well, it's already started rolling over 9 trillion this year of old debt that they need to roll over. I think it's going to get harder and harder, not just because the cost of this war and the cost of all the destruction of its military infrastructure in the Middle East and its allies, but also because it's going to convince more and more countries, even allies, that it might not be a good idea to lend too much money to Uncle Sam, not just because it might come back to haunt them in that you're financing the institution that's coming after you, right? Well, you know, and it's reasonable to say that because President Trump talked about Greenland. That's an ally, right? So, but not just allies, but countries that are not aligned with the U.S., I'm sure they're going to think really hard about increasing their treasury holdings. So it's going to become harder and harder. The world is going to de-dollarize more and more. And countries like Japan and South Korea, they are very dependent on oil from the Middle East. Their stock markets have been hammered today. And I think they might have to sell a lot of their dollar reserves to cover the cost of oil going up so much. Ever since this war started, the 10-year yield has been going higher and higher. It was below 4%, and now we're at 4.20, up 5 basis points, and I think it's going to continue, unfortunately, for you, the taxpayer, for you who's not in the top 1%, right? I think it's going to get harder and harder. How do you cope with that? Well, I think the first most important thing is that you know what's happening. Don't buy into this mantra narrative that I hear now that all of this is short-term pain for the long-term gain, right? Because, don't get fooled by that. Do what you need to do to help yourself, and don't listen to these people who start the wars, right? Don't listen to them. What about the 30-year yield? Well, that's approaching 5%. It got up to as high as 482 overnight. Right now it's at 480, so it's not going to get better. What will that mean for you, aside from having to pay more tax, having to pay the silent tax of inflation? The general public is going to pay in higher mortgage rates, because you can bet mortgage yields are going to go up even more than treasury yields. The Uncle Sam is going to crowd out the mortgage sector, and the same thing is going to happen here in the UK.
A financial commentator and market analyst Clive Thompson notes that gold and silver prices experienced a modest pullback, with gold falling slightly and silver also declining as broader financial markets weakened. He explains that during periods when equities and other assets drop sharply, investors often face margin calls and are forced to sell whatever they can to raise cash. In the early phase of market stress, this can temporarily push precious metals lower as well, even though the selling is mostly driven by leveraged traders rather than changes in long-term demand. Despite the short-term pressure, he suggests that once markets stabilize, gold and silver could recover strongly, especially in an environment of rising inflation combined with economic slowdown. Clive Thompson also highlights that mining stocks and exchange-traded funds tracking gold producers may fall significantly in the short term because investors tend to sell their most profitable positions first to secure liquidity. However, he believes the outlook for mining companies companies could improve in the coming months as higher gold prices from late 2025 and early 2026 translate into stronger earnings reports. At the same time, rising government bond yields across the United States, Europe, and the United Kingdom indicate that investors are increasingly concerned about inflation rather than seeking safety in bonds. According to him, increased military spending and higher energy prices, particularly oil, are likely to push inflation higher, reinforcing the longer-term case for precious metals. Let's get back to the video.
Let's have a look at gold now this morning. So we'll go to the gold price. So it's recovered a little bit. I saw 5050, 50 earlier today. It's now down $79 at 5,089. And silver, which is 1.59% down, silver's down 1.22% at 83.43. Now, when prices of equities are falling and other things are falling, it's only normal that gold and silver should get carried down with it. People are getting margin calls. There's obviously going to be plenty of leveraged people out there. They'll be getting margin calls, and you must expect in the early stages that everything will fall. Of course, once we get some sort of stability, then we'll see what rises from the ashes first. And I think that gold and silver should do quite well because of the prospect of this inflationary environment coupled with recession, where it's not good to invest in anything except something which is going to keep pace with inflation. Of course, you can look at US TIPS, that's Treasury Inflation Protected Securities. I haven't looked at them myself, so I can't tell you if they're good, but it's something that perhaps people are looking at the moment. The GDX and GDXJ, the two exchange-traded funds which track mining shares, gold mining shares and junior gold mining shares, they are both down and will fall heavily when the market opens tonight. The reason for that is people having to raise cash, and they raise cash wherever they can, and these two indices are well up on a year ago, so it's quite normal people sell their most profitable positions first, so they try and keep some of their profit. So it's hard to say that we're in an environment where these things are going to jump tomorrow. I don't think that's the case. But if you're not a nervous Nelly, you can hang on to them, and we'll see in a month or two, in the next few months, the next 6 months, 9 months, we'll see much higher profits reported by these mining companies due to the fact that the average gold price in the fourth quarter of 2025 was much higher than the third quarter, which is the one already reported, and due to the fact the gold and silver prices in the first quarter of 2026 are higher still. So what does that mean? It means that probably we will see, after we've had the decline, and we're going to have a decline, there's no messing about. It probably means that the prices will start to come back as these higher profits announced. Let's have a look at the bond market, just see how the US Treasuries are trading around the world. So we'll go to look at the US 10-year Treasury here. Yield is going up. It's 4.18. That's not the future we're looking at, that's the spot. And the 2-year yield is also rising. It's, if you see here, 3.62%, up from 3.3%, something like that. Yields are rising in lots of other countries as well. Italy, you can see it going up. I'll click on that. That's Italy. You see the spike up here in the yield. We can look at the European 10-year, the EU, which is AAA. Again, you see the spike up in the yield recently. Let's look at the UK. We'll look at the UK 10-year yield, 5.38%. Again, in the last few days, another spike up in yields. So rising yields when there's war is kind of unusual. So in this case, it means that people are not running for the safety of treasuries or gilts or bunds or OATs, OATS, that's the French one, Obligation Assimilée de Trésor. They're not running for the safety of those investments. Instead, they're concentrating on the inflationary risks, which have been driven by increased government spending on military and, of course, driven by the higher oil price, which will feed through to everything which has to be transported and everything which is manufactured with some sort of plastic in it.
Despite experiencing short-term declines caused by market volatility, margin calls, and leverage trading, gold and silver remain well-positioned for a significant recovery as inflationary pressures continue and energy costs rise globally. Mining stocks and ETFs tied to precious metals may see temporary setbacks as investors raise cash and secure profits, but the underlying strength of rising metal prices is expected to drive stronger earnings and support a rebound over the coming months. With government bond yields climbing across the United States, Europe, and the United Kingdom, coupled with mounting global debt and ongoing geopolitical tensions, holding physical gold and silver provides a reliable hedge against financial instability, currency devaluation, and long-term economic uncertainty, reinforcing their role as essential assets in a diversified portfolio. How can investors balance short-term market volatility with the long-term benefits of holding physical gold and silver? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.